My team and I decided to do this video once a week. We're going to do a real estate roundtable. We understand that everyone's having a hard time with this at home, and but we want to be a resource for you guys, keeping you up to date on the real estate market, what's going on with the overall market in San Diego, and then today we also have Ashley Ortega joining us, and she's going to update us on the lending side. So both on purchase loans and refinances. So I'm going to go ahead and start on the first topic, which is the overall real estate market. I've had a lot of questions and conversations with past clients, friends, family, and it typically always comes up. They ask how the market is and how work is. So I want to kind of go into that, and then we'll just have an open dialogue on the overall real estate market in San Diego. So as of now, with the stay-at-home order and then real estate now being deemed essential, things have kind of been slow to pick back up again. People are obviously being really cautious, which is a good thing. And the downtown market, as well as San Diego's market, has definitely seen the effects. So I know that we'll talk about a couple different areas and then just the market in general. But in San Diego, inventory is down about 28% from last year. And we are seeing the overall market kind of feel the effects. And so I just want to get your guys' opinion on what you're seeing out there right now. Fabio, you want to start? You're muted. Technical difficulties.
I'm trying to avoid the background noise. So what the inventory looks like in terms of like San Diego in general, or are you trying to go like a specific area? Because I mean, that's something that we need to be careful too, because I think certain areas have even less inventory than, some other ones that you might be considering.
Yeah. Well, I mean, like for example, in San Diego, in April last year, there were about 7,200 listings. And right now in San Diego, there's about 5,300 listings. So about a fourth less listings. But what are you seeing in some of the areas that you focus on just in general?
Well, I mean, and this is the trend that we saw, since last year, and I think it got worse at the beginning of this year. I'm talking specifically, let's say Chula Vista, for example. The beginning of this year, inventory was really tight, and we were seeing a big difference between supply and demand, which was causing, a lot of these homes to have multiple offers. And I think with the current situation that's going on, some of those sellers are still considering kind of holding back to see what's going to happen, which is creating even a bigger problem with inventory. So I think see right now in Chula Vista alone, and March, inventory dropped another 47% compared to last year around this time.
Yeah, and it seems like property is still selling down there. I didn't look up the numbers for there specifically. Can you talk about that a little bit?
So yeah, there's still sales going on. I didn't dive into kind of what the numbers really look like, and that's something that I want to look at. I think we need to be careful too in looking at what's actually selling and what's going into contract, because a lot of the homes that are selling right now were going into contract before the whole stay-at-home order really kicked in and everybody started really, figuring out what was going on, so on and so forth. And then also, I saw a lot of those homes come back in the market for XYZ reason, and that's something to like further into too. But yeah, you're right. I still see things moving nowhere near as fast as they were moving back in the beginning of March, end of February.
Yeah, I mean, to be honest, I think that especially if you're in that $400,000 to $600,000 price range for a detached home, or $400,000 to $700,000. Yeah, no, not four. So, but like for $500,000-$600,000, those houses seem to be selling still, maybe not as quickly, which is kind of good. I mean, to be honest, right before this, so February, March, beginning of March, we're seeing, multiple offers on homes again, and sometimes 10, 15 offers. I know that I submitted an offer for a client and we went up against, I think 12 offers total. It went over $100,000 over list price. It was, undervalued, I think, and the market reflected that. But still, I don't think that's healthy. So maybe slowing down a little bit in that price range is a good thing for consumers, for buyers. And I mean, I know different markets are seeing different numbers. I focus mainly downtown, and sales are down about 43% now in April. So compared to last April, which is quite a big difference. I don't know if people are a little bit more hesitant because of the density right now with everything going on, or if it's just it might be because it's a I don't know. I don't know the proper term for it, I guess discretionary market. Sometimes people don't need to move downtown. They're choosing to change their lifestyle. And right now you can't even enjoy the lifestyle that you're buying into. But Claremont's probably still hot. Carl, can you talk about that a little bit?
Yeah, so Claremont, I mean, in the last 30 days, they've had 31 active listings. There's 24 pending and 17 have sold. So it's still moving. The average price point that sold is $745. But if you look at like Bay Park and Bay Ho area, there's only 13 active listings. So I feel like there's a little bit less than normal. 3 are pending and 6 have sold, and most that have sold are average right around $1 million too. So it's definitely still moving in some parts of San Diego.
Yeah, I looked up 92103 and 92104, so like Mission Hills, Hillcrest, North Park area, and those two zip codes combined last April. So from April 1st to April 24th of April of 2019, there were 59 sales, and the same time period this year, there's 48 sales. So that's only a 19% drop. Considering everything going on, it seems like the central neighborhoods are still moving pretty quickly. Obviously, less listings available, and with that, it's a lot of it's probably people are hesitant putting their homes on the market. They don't want to allow people into their home, so obviously, like, virtual tours are becoming more and more common. Matterport, which I wasn't a big fan of Matterport before. But now I'm starting to like Matterport a lot more, which is the 3D tours where you can walk through room by room virtually. I think before I didn't really like it because it took away that personal aspect of a buyer actually walking through the house and getting that emotion from it, and actually seeing if it's the right one, if it's the right fit. Whereas now it's becoming necessary to do stuff like that. So. I definitely think that people are going to be more hesitant. We've talked about different clients and their situations, especially if they have kids or maybe they're a little vulnerable. They're older and or have a health defect, not defect, but health condition.
Yeah,
So
I just looked up Claremont from 2019, and it actually has the same amount of active listings and one off on pending. So, I mean, it seems to be doing similar to last year, which is pretty crazy.
Yeah. Fabio mentioned some cancellations, and I think we've all seen that across the board in San Diego. I kind of want to talk about that, and there obviously there's a lot of new forms with our contracts and everything protecting people if they do get COVID-19, allowing them to cancel. Prior to all of this, we didn't have those forms. So, we kind of had to adapt pretty quickly. I think a lot of the reason why there are cancellations too is the lending industry. So I want Ashley to talk about what's going on in the lending world and what are you seeing right now?
There is a lot going on. A lot's going on. I don't know where you want me to start, but I mean, everything from interest rates to, lending, different mortgage companies to loan types to all that good stuff. But I would say just, first and foremost, just like real estate, mortgage is essential, and, we're operating normally. You know, everyone's working from home, but we're fully up and running, and the industry has adapted, you know, just like any other sort of business. You know, appraisers are still appraising. A lot of loans are allowing drive-by appraisals, you know, Fannie Mae, Freddie Mac, even VA in some cases. And then notaries also are, you know, showing up to signings, gloved and masked, and able to execute loan documents with the, you know, borrowers that way. So everything's kind of rolling the same in that direction. Yeah. I guess maybe we could go over maybe some of the different loans. So as we know, jumbo loans have sort of changed, jumbo financing, and then non-QM, which became pretty popular the last, you know, year or so, which is alternative financing. But those are the two loans or the two lending avenues that aren't really backed by the government, right? Excuse me, aren't really backed by the government. So with those, just like 2008, if we look at the housing crisis in 2008 or that recession, a lot of those have just suspended, right? They're not lending. And if you are seeing those types of loans out there, they come at higher interest rates, and then they're tightening up on their guidelines on those loans.
I've heard of some of those being pulled back, like right at the closing table. I mean, one of our office managers was talking about that. I guess in Rancho Santa Fe, they've had some that have pulled out right before closing, right before funding the loan, and kind of left the buyers in a situation. And I thought that once they're committed, they were committed. I didn't even realize they are able to back out in the last second. But I guess,
so that is, so nothing's really guaranteed until the loan closes. And that has been happening. I mean, it really hasn't happened on our end yet, but yeah, I mean, they can pull out. And that's what happened to pretty much like all the non-QM and then a lot of the jumbos too. And it really depends like who the lender is too. So you have like your different lending avenues. You have your brokers, you have your correspondent lenders, you have your wholesale lending, then you have your retail. And any sort of like broker type or correspondent or wholesale, that's when you don't really have control. You're using everyone else's money to lend. And so those, I mean, if you're kind of sitting in one of those categories right now as a lender, it's not going very well. But yeah, there was a lot of pullout. So we have multiple jumbo investors, and they, some of them, you know, called for suspension, but they did not, you know, pull the rug from, you know, under our buyers or clients, which was nice.
So they're stopping new loans essentially.
Yes, exactly. Exactly. So
can you talk about a little bit about how the requirements have changed? Specifically, so jumbo, like what that looks like now. I know before people were getting 10% down loans. I know that's a struggle.
So any like higher risk type guidelines, or, you know, where you were able to get a little more flexible. So maybe an 80-10, you know, where you do an 80% first, and then you know, you follow it with a 10% second. You know, some of these HELOC investors out there have suspended some of their products, you know, just because it's a subordinate financing and second lien position, so it's high risk for them. And then just tightening of guidelines in general. So, you know, allowing certain types of income, or, you know, like restricted stock units, let's say, or I don't know, just other types of income. So, and then of course, you know, they've tightened up on loan to value guidelines and all that good stuff. So, I mean, when you're going in for a jumbo loan, it's going to be pretty scrutinized right now, and you have to have a very, very clean file for the most part. There are still some non-QM lending out there. We have an investor that, you know, is still, I mean, and they're so busy, right? Because they're really one of the only ones left, and they've been in business forever. They have a pretty good solid base and foundation. So there's still some of that too. So we just have to be extra careful, you know, when pre-approving, you know, buyers for their loans, and really making sure that their financials, you know, and everything else meets these new, you know, restricted guidelines.
All right. What about, so I heard VA and FHA, the cost might be going up. I don't think you and I discussed that, but I was talking to someone else and they were saying that the loans are getting a little bit more expensive to fund, or they have stricter guidelines now with minimum credit. Have you seen that at all?
No. So that actually might be lender specific related. So
Okay.
we're actually, I mean, for us, like VA and FHA, any government backed like USDA, anything like that has not changed for us at all.
Okay.
So in fact, our interest rates not right now are sort of, we're sort of like a market leader in that area. So if you were to compare our interest rates to other lenders, we're pretty much leading in that market. So we do a lot of VA financing. You know, we're a national lender, so we're across the country, but locally in San Diego, you know, our office, you know, does do a lot of VA. So we're not experiencing anything really in regards to those loans. Everything's still operating the same.
Hey,
Okay, so it's mainly
for Ashley's sake, I think we should timestamp this call. It's Friday, April 24th, 1:23 p.m.
Good point. Good
Things are
point.
changing so quick, and if we're gonna be sending this to like our database, be like, oh, you know, nothing changed with the VA, that can change on Monday.
And that's the crazy part about the mortgage market right now, is it is literally changing day by day by day. So I mean, we just had, this is the newest news out, which a lot of people probably don't know, but you know, the whole forbearance issue. You have people that are experiencing a financial hardship or losing their job, and they're not able to make their mortgage payment now. And so, you know, they're requesting these forbearances. So there's really two parts of lending. There's the origination side, which is where I am. You know, I originate the loan, and then once it closes, it goes to servicing, and then that's where the back end of the loan happens, is we're servicing. So if we're closing loans and then we're closing them, and in the middle of a servicing on board, the borrower requests a forbearance, that servicer is not going to want to buy the loan or onboard the servicing. So that's a real issue right now.
And then, I mean, also, I think the servicers are struggling with that because they still have to pay taxes, they still have to pay insurance, and if they're not getting that money, I mean, with people not paying their mortgages, I think that could be a big issue down the road.
Yeah, so Fannie Mae and Freddie Mac just agreed that they would buy these forbearance loans on the back end and allow for up to a 4-month forbearance. But see, the thing is like nothing really comes for free, right? So they have to build in this somewhere. And now, sorry guys, now we're realizing that there's a cost to that. So great, people can have these forbearances now, you know, post-close with servicing, but now Fannie Mae has said, well, it's going to come at a cost. And so now they're going to charge all new consumers coming in for that cost. And it's a pretty hefty cost. And, you know, with mortgages and homeowners today, they're really saying like this is the one area that can actually help people. If you're a homeowner, you have equity, you know, you're equity rich, right? And so people need to refinance and maybe pull the cash out of their nest egg to kind of live a little bit. But now they're passing this cost on to all new consumers, which is going to increase the interest rate, and they're going to have a much more difficult time obtaining financing and saving some money. So this is the new issue that has come up in the last like 24 hours.
Interesting.
Yeah, it's kind of a big deal in our market right now. So we're hoping maybe, but this is the thing, is like it's changing every day. So maybe next week they'll realize, uh-oh, that was a big mistake, and let's go back and fix it. So, you know, they're having to come up with these solutions so quickly to keep the economy upright, you know, instead of sort of defaulting, and, and there's pros and cons to all of this. So they do it, and then, then it affects this. And so it's definitely been hard to follow, but this new issue, I'm hoping they'll kind of fix it. And
it seems like it's unclear too. Like, the forbearance, for some reason I'm echoing.
So one thing that I wanted to add, because, at the beginning of this, a couple of my clients were hit it right away. And, I advise them call their bank, see what programs they can take advantage of to help them kind of get through the next couple of months. But then they started hearing, well, if we go through forbearance, that can affect us down the road, qualify for another loan, And I think there's a lot of that going on right now. So my advice that I tell them, I was like, honestly, I don't know what's going to come down the road. I don't know what the lending world's going to come up with in the next couple of months. My best advice is do what's right now. Do what you need to do to get to the next couple of months, and just kind of see what comes up in the next, after this is all gone through. What would you tell like an owner that has a house, let's say both the spouses, both of them got laid off and they can't make their mortgage? What would you recommend for them to do at that point? As a lender?
Yeah, well, for me, it really depends on them financially. Like, do they have savings? If it's, I would definitely, especially like with these forbearances, like they're going to hit them in the end. So let's say they missed 4 months of payments, and that's $12,000. When 4 months comes up, the lender's going to say, the servicer's going to say, okay, give me $12,000. Well, we don't have that. A lot of people don't have that. So then they're going to have to maybe do a loan modification, which is going to affect their credit. So I feel like these forbearances are for the people that really need them. Like they don't have cash savings. So if they can float their payment a couple months and maybe pull from their savings or, their E-Trade account or something like that to make it, they're going to be better off doing that in the long run. Now, if you just don't have any money, then, that's what you have to do. It's either that or, maybe possibly losing the home, which I'm sure is not an option in their mind at that time. So it's for my opinion is it's really for the right person, but you have so many people that just kind of hopped on it, not realizing what the long-term, repercussions could be from the forbearance right now.
Mm-hmm. Gotcha.
Yeah, it doesn't seem, it seems like there's a lot of misinformation out there too. It doesn't seem very clear on that as to what the plan is.
For me, like when Fannie Mae and Freddie Mac, I don't know if it was yesterday, but when they first, announced like, hey, yeah, we're going to support the forbearance, it was like, cool, we're headed in the right direction. But then like, wait, not cool, because this is what's going to happen now. And it's affecting, it's going to be a long line of effects. So if they can't fix it, it's going to be passed on to the consumer, which is going to impact the housing market, which is going to impact buyers buying homes, which is going to impact, you know what I mean? Like so right direction and then wrong, like I think that was the wrong direction. So there's a lot more they have to smooth out to it, but and then I don't know, we could touch on interest rates a little bit. When COVID first happened, obviously, if anyone was watching the news,
they were crazy.
Yeah,
super volatile.
You would, like at 8:43 a.m., you'd have a 3.25% rate on a conventional loan, and then at 10:15 a.m., it would be at 4.25%. It was crazy. So at least the rate market has chilled out a little bit. We're not seeing these huge increases and decreases. So, managing the pipeline and locking in interest rates and making sure clients get the right rate isn't as stressful anymore. So that's a good plus. So, but we're hoping these Fannie and Freddie loans, the interest rates don't go up a ton for these people, because that's where they're gonna pass along. So a day-to-day thing, but the mortgage market is still there. There's still options. There's a lot of support out there, and I would say like, hey, if you can qualify to refi at a lower interest rate, reduce your payment, or maybe pull a little bit of cash out, of your, equity nest egg, to live a little bit better, during these times. That's a good thing to look into.
I think that's a big misconception some people have in terms of like, hey, well, this is finally going to cause the prices to go down in San Diego. But I don't think they realize that a lot of these homeowners have a lot of equity in their homes where they don't have to, sell the property to make it through. They can refi, take some of that money out, and get through for a good amount of time. Again, I haven't really gone into the numbers per se, but I know there's a lot of homeowners with plenty of equity in their homes where they don't have to get to get out of this situation.
Yeah.
Well, I think keeping current matters on a national level was saying something like over 50% of homeowners have 50% or more equity in their house. Yeah, that's which is a crazy stat. That's obviously nationwide, though. That's not San Diego based, and to get those numbers for San Diego is really difficult. But it gives you an idea of the foundation that this market's built on versus 2008. I think it's very different situations, very different settings. Obviously, like I'm not overly optimistic on how quick the recovery is going to be. I'm not an economist though, but I think that there are going to be repercussions for everything going on. Obviously we fell into this pretty quickly, but I do think that housing is going to be looked at differently than it was before. In 2008, it was looked at as, it was the lender's fault. It was the real estate agent's fault. It was all these things. But now it's seen as a positive thing because your home is your sanctuary right now. I mean, it's your bubble. It's where you feel protected with everything going on, and the amount of equity that people have in their homes. A lot different than 2008. So I want to get into the last set of questions. We talked about the market. We talked about lending. And then Fabio touched on people asking if prices are going to drop, and so is it the right time to buy right now, and is it the right time to sell? Like what I want to discuss that a little bit because it's a question that I get a lot from people that either want to do something or need to do something, and what does that look like moving forward? I'll go ahead and start on that. I mean, on the buy side, depending on what price range you are in, you're competing with less people. I mean, across the board, you're competing with less people. But if you're looking under $750,000 in first quarter of this year, you were likely competing with other people, especially if it was a desirable property. And this is basically anywhere in San Diego. I mean, under 750,000, things are moving pretty quickly. Even under $1 million, things are moving pretty quickly. And now you're competing with less. And so if you have the ability, like obviously employment is secure, and you're comfortable with making that decision financially, it might not be a bad time because you're competing with less people. Property's not flying off the shelf as it was prior to all of this. Things are still selling though. I've looked at 3 different properties in the last week for a client of mine, and all 3 of them went into contract, but I don't think they had multiple offers. And some of the properties that we looked at previously that sold recently have sold a little bit under list price versus selling over list price in the $400,000 to $600,000 range. So what are your guys' thoughts on things?
Carl, you want to go? You want me to go?
You can go ahead. I'll go after.
I think, when I get that question, it's more than anything, it's letting them know that we have to make sure that everybody's safe, right? Like taking people out to houses that are vacant. Obviously, there's easy measures that we can take. As a team, we're all wearing gloves, booties, we're wiping down everything we possibly can to keep people safe. But then you got to realize sometimes too, there's homes that are being owner occupied, tenant occupied, and we have to do everything we can to keep you safe. But at the same time, as professionals, we have to realize like, hey, are we missing out on the right home for you because of those measures? So it really comes down to very specific people's situation. Like, hey, can you wait it out and see if there's more inventory coming in the market for the right home for you? Or do you need to do something now? And I think that's something for our clients to decide, right? Like, hey, maybe I don't need to buy right now. Maybe I can wait and see what else comes on the market and take advantage of more opportunities. But then there's the other side too, where you're right. I mean, I was helping a couple people earlier this year in that sweet spot price point in Chula Vista under the $650 for a detached home, 3-bedroom, 2-bath. And we were going against 15, 20 offers. Homes were going over 30, 40,000. So for those people, if, like you said, if they feel comfortable financially and they feel comfortable with the process that we're going to help them get through, I think right now is a good time because there's definitely less competition than there was earlier. We just have to make sure as professionals that they're comfortable with all the adjustments, you know, the drive-by appraisals. How's the inspector, how deep is it really going to go into the inspection considering health concerns? All that stuff needs to be discussed up front, just that the client feels comfortable. It's a big purchase. And, you know, at first I was having a little bit more time with the drive-by appraisal. Like, I don't know how to do that. You know, like, I want the appraiser to go on the property. I want them to look at everything. I want them to run the numbers because that protects my client as a buyer. Obviously, we do our due diligence and provide all those stats to support the appraisal. But I think as long as we're upfront and we're considering everybody's safety, people that feel comfortable buying should definitely take advantage.
I'll have to agree on that appraisal thing too. Especially if you're trying to get value, you know, they've just done a heavy remodel and you know what I mean? So, you know, I have a couple purchasers through the same thing. They're like, nope, we want a full appraisal. And that's, you don't have to do a drive-by, but full appraisal, full value. Yeah.
I have a listing in escrow right now and the buyer's appraisal actually got waived. The lender waived the appraisal. It's in a high-rise.
Lots of waivers.
So it's kind of interesting.
Wow, that is interesting. Huh.
Carl, your thoughts?
Both of you pretty much nailed it. So as far as like buying, I think that if you are looking in a specific price point and you do feel comfortable with your job and your position, then I would go ahead and start looking because I mean, you could potentially get a deal when you wouldn't be getting one earlier in the year too. So I mean, I agree with both of you completely. Yeah.
Well, one thing I want to talk about too is the luxury market because that is being affected more than anything else right now as far as like the slowdown. Downtown San Diego was a little bit slower than most of the San Diego markets in general. And that's only increased since all this happened. But I think the luxury market is going to struggle a little bit more. And there's a few reasons, right? Jumbo loans not being as available, harder to get, especially if you needed to use other forms of income or ask for exceptions on certain things. You're less likely to get it right now. You also have to come in potentially with more money down. So, you know, if you wanted to come in with 10% before, that's not an option anymore. And then on top of that, if you look at the stock market, a lot of people are going to be hesitant to pull that money out of the stock market if that's where they're holding it. And, you know, with the stock market being down, how much is the stock market down right now, Carl? Approximately, like across the board?
I mean, it's a lot. I haven't looked at the recent one. I think it went up again today.
We talk about like Dow, for example, it's probably like 20%.
Yeah, right, something like that.
So, you know, they're taking a hit on money that they're pulling out. And a lot of people won't be willing to do that. So I think the luxury market, if you're in the luxury market and you're looking for a home and it's going to be your place to live, if you have the means, you're job secure and everything, and you feel comfortable with it, you could potentially negotiate a better deal than what you would have before, in my opinion. So there's a lot less competition out there in the luxury market, and to be a buyer right now in the luxury market, I think you definitely have the upper hand. And so basically all of this is going to be the reverse on the selling side. So luxury sellers right now, probably not recommended if you don't have to sell right now. Right now is not a time to test the market. I've had conversations with several different sellers, lately who were thinking of maybe putting their home on the market. And I don't know if that's advisable right now. I don't know if I would do that given the amount of inventory that's on the market in the luxury realm. And especially if it's owner occupied. I mean, there's no reason to take that risk right now for not very good odds that you're actually going to be able to find a buyer for your home. Obviously we can do all of the virtual tours, we can do videos, all that to minimize the amount of people going through your home. But I think that with everything going on in the luxury realm, I don't think it's the right time to sell if you don't need to. That being said, some people have to sell. So given their situation, I have a listing coming up next week, and the tenants moved out, so it'll be priced around $900,000, and it's just going to sit vacant if we don't put it on the market. It's going to be vacant anyway, so it's going to be costing the seller money. She might as well try to sell and see if we're able to find the right buyer. But in the lower price ranges, there's still very, very low inventory in San Diego County. It's still seen as a seller's market. I think property's still selling really quickly, depending on the neighborhood. Even Carmel Valley, for example, under 1.5, it's still moving pretty quickly. So it just depends on your specific situation and what segment of the market you're in. But if it's owner occupied, if you live there, we could try to do as much as possible virtually. But obviously, we wouldn't want to put your health at risk.
Hey Ryan, I have a curveball question for you.
Yeah.
Do you think this virus is going to affect how people look at high-rise living? Considering everything's going on, some like residents are afraid to even go down the elevator or press a certain button, open a certain door just because they don't want to touch things. Do you think this is going to change the perception of some people living in high-rise?
That's a tough question. Thanks for that, Claudio.
I just want to hear your opinion because I know you. So I've lived in downtown for 3 years. You lived here a lot longer than I have. You come in contact with a lot more people that live here, and you know that I think you understand the lifestyle a little bit more than I do. So I'm just curious to get your opinion. I know what I think of it living in a high-rise myself, but I just wanted to see kind of what you thought.
So I was watching, I've been watching CNBC, just following the stock market and everything. And they were literally just talking about how, this likely isn't going away anytime soon until there's a vaccine that's readily available for, the masses. This likely is something that we're going to be living with for a while. Now we're going to learn to adjust to, to live with it basically. And obviously they're going to try to improve treatments and everything which will reduce the risk. That being said, I think just over the last month, I don't know if you feel a lot different about the whole situation, but I know when this first started, there was, people are still worried right now, obviously. It's a big deal, but I feel like people are learning to cope with it. And I think as this goes on, people will learn more and more how to live in the world that we live in right now, given the situation. And I think downtown is no different. I think that as things start opening up again and the lifestyle that we learn to love starts being a little bit more normalized, I think that will ease some people's worries. Now there are going to be a portion of people that don't want to live downtown because of the density, and that goes not just downtown, but like central in general, right? Higher density areas, they might be hesitant to move into those areas. But I will say my building's cleaning staff, like, very appreciated. We have hand sanitizers in the elevator lobbies, not just in the main lobby, but downstairs as well in the garages. The cleaning crew is doing a great job, always keeping things clean. And so overall, I think that, the buildings are going to try to take the proper measures to reduce the risk as well. I don't think that, I don't know. I don't see that changing in the long term. I don't think that that's going to deter people. But right now it might. Yeah.
Which one in your opinion?
Yeah.
What's your opinion? What's your opinion? You said you had an opinion.
I think in the long term, I think I'll be going back to normal, especially somewhere in San Diego. I mean, if you look out the window right now, it's probably like what 75, 76 degrees, beautiful day. So you can still walk outside and enjoy it. But I think especially in the luxury market, a lot of people that have this as a second home might change it to somewhere with a backyard. You know, just in case that we're ever caught in a situation similar to this where you're stuck to your house. Hey, well, let's go to our house with a yard so we can, you know, enjoy the outdoors. So that's just kind of a thought that I had. I think over, you know, the long term, I think people are you know, sadly going to forget about this and go back to life as is, hopefully, and continue to enjoy living in downtown and just going back to as close as normal as possible.
The other thing, to be honest, is downtown San Diego is not that busy. Like we're not Chicago, we're not New York. We don't have that high of density down here. There's not. I mean, it still has that small town feel. I know a lot of times when I have clients coming into town and they're looking at property and they're not from here, they always call San Diego kind of quiet. Downtown San Diego, it's not like a lot of the other big cities. It's not really a big city, in my opinion. It's kind of a pretty tight-knit community, and it's not as busy as you would think. So I think that maybe the long term, I don't think that it's going to have an effect on some other cities. You know, I think people will start thinking like San Francisco, Chicago, New York. Like I think people are going to be a little bit more hesitant to be in that big of a city. But downtown San Diego is a lot different from those areas.
Yeah.
So, all right.
Cool.
Good.
Well, thank you, Ashley, for joining us and adding some insight, and always a pleasure to talk to you. And thank you guys. Do you guys have anything to add before we end this call?
No.
All right.
I would.
Oh.
I mean, if you don't mind.
Yeah, no, of course.
I would just like to express the importance of, you know, really working with the right realtor, you know, whether you're selling or buying, especially, you know, in a market like this where, you know, so much has changed so quickly. You need a real professional that is, you know, sort of holding your hand, as Flavio said, to make sure that you're taken care of. And then as well as the lender too, you know, make sure you're working with someone great that, you know, has your back and your best interest, and we'll get the loan done. So this is a new market we're in. So, you know, you definitely need the right team to be working.
I definitely agree. I think professionalism and just overall knowledge is going to be a lot more important right now than it was in the past. I mean, it's always been important, but I think during these times it's even more important. So, all right. Well, thank you. And it was great talking to you guys and catching up. And hopefully if you're watching, you enjoyed this. All right. Thank you.
All right, man. Bye.